Welcome to The Debate. Today we're tackling a critical tension faced by successful, high-income earners. This fundamental conflict between ruthless investment efficiency on one hand and the desire for maximum financial flexibility on the other. So, on one side, we have the conviction that maximizing long-term compounding, well, it demands the capital stay fully invested, capturing every possible risk premium.
And on the other, we have to recognize that true wealth management requires more than just maximizing returns. I mean, it demands security, it demands resilience. My side argues that holding substantial cash reserves is a necessary form of insurance against the unexpected shocks that, disproportionately affect high-cost households.
So the central question before us is simple, but it's also profound. Does excess cash, so capital beyond immediate needs, does it represent an inefficient, costly drag on long-term wealth accumulation? Or is it a crucial form of optionality and insurance against volatility and unexpected personal crises?
Right. And I'll be arguing that cash, when it's held strategically, is not a poor asset class at all. It's a non-negotiable risk management tool, and I think a vital source of psychological stability that allows high earners to act decisively when opportunities or crises arise.
And I will argue that cash is fundamentally a subpar asset. It sacrifices superior compounding returns for a perceived but mathematically costly safety, and this sacrifice results in a measurable long-term erosion of wealth. So my core thesis is it's really grounded in quantifiable loss. Holding excess cash is an active choice to forgo the market risk premium, and this choice comes with a pretty severe price tag, one that's magnified over time. Let's just start with inflation. Cash historically is just brutal at preserving purchasing power. If we look at the 6 decades between 1960 and 2022, cash produced an annualized real return of just 0.7%.
Only 0.7%?
Exactly. In real terms, after inflation, your cash is basically standing still. It's barely maintaining its purchasing power, which is devastating over a 30 or 40-year accumulation period. This is the silent killer of wealth. And the opportunity cost is perhaps even more compelling. I mean, the great benefit of investing is compounding, and when capital sits idle in a savings account, that engine is just turned off. If a high earner holds, say, $1 million in cash, and the broad market moves up by a relatively modest 8% over 12 months, that investor has permanently forfeited $80,000 in gains. That's not a hypothetical loss. That is money that will never compound for the rest of their life. So I'm just not convinced by that line of reasoning, the desire to hold cash for safety, because it so often masks the behavioral flaw of market timing. History shows that even the most notoriously terrible market timers, those who invested at the absolute market peak every single year, they still outperformed those who perpetually stayed in cash, waiting for that perfect entry point. Staying out of the market is just the costliest mistake of all.
Well, see, I come at it from a different way. You're defining cash solely by its return profile, and in doing so, you're, I think, ignoring its primary function, liquidity and operational resilience. For the high earner audience we're talking about, we have to throw out the traditional 3 to 6 month emergency fund advice. I mean, given larger mortgages, higher property tax burdens, and specialized career risk, that cushion is simply inadequate. Cash provides, and I'm quoting here, significantly more financial protection than relying on discretionary income alone. We know that over half of U.S. households experience some kind of financial shock annually. Now, for a household with $20,000 or $30,000 in monthly fixed costs, that shock is magnified, right? A cushion of 6 to 12 months, or frankly, even more, is appropriate specifically because it manages illiquidity risk that discretionary income just can't cover instantly. Furthermore, cash plays an absolutely non-negotiable role in managing what is probably the most dangerous risk of all for retirees, sequence of returns risk.
That's often associated with the distribution phase, I agree. But I'd like you to clarify exactly how cash mitigates that specific danger.
Absolutely. Sequence of returns risk, or SORR, is the risk that a market downturn occurs early in retirement. forcing retirees to liquidate huge portions of their principal at depressed values just to cover living expenses. This permanently depletes their portfolio, making recovery almost impossible. It's catastrophic. By utilizing a strategic bucket strategy where liquid cash covers the first 3 to 5 years of projected expenses, retirees ensure they never have to sell a growth asset into a down market. That cash buffer buys them time. It buys time for the market to recover. This capital preservation property, preventing that kind of catastrophic selling, provides value that is exponentially greater than any minor return foregone on that cash. And finally, the psychological value of having that deep cushion. It reduces the chance of financial distress. Low volatility is itself a form of value for less risk-tolerant investors.
I acknowledge the absolute necessity of emergency funds. And yes, the value of protecting against SOR in retirement. But for our core audience, high earners still in the accumulation phase, often decades away from needing that distribution bucket, the argument shifts dramatically toward efficiency. If the goal is wealth growth over a long horizon, the consensus investment framework shows that cash is the least efficient asset. And we can move beyond, anecdotal psychological comfort and actually quantify the exact price tag of that optionality using the certainty equivalent measure.
I know that measure is deeply technical. For our listeners, what exactly is the certainty equivalent, and how does it relate to holding cash?
So the certainty equivalent, or CE, is a sophisticated metric used in economics to measure overall investor welfare. Essentially, how much certain cash return you would accept to forego a risky investment. Studies use it to calculate the welfare loss associated with deviating from an optimally efficient portfolio, say by over-allocating to cash. And these studies demonstrate a quantifiable loss of welfare. It ranges from 2 to nearly 20 basis points annually when an investor over-allocates by just 10% to cash. In plain English, the measured psychological benefit you gain by holding that extra cash is measurably costing you, on average, a significant amount in compounding returns year after year. And crucially, investors with longer time horizons and higher risk tolerances incur a greater cumulative cost because that risk premium forgone just compounds over time.
That's an interesting point, though, but I would frame it differently. Since a certainty equivalent attempts to measure overall welfare, it implies that cash provides a psychological benefit, an anti-fragility premium, if you will, that a raw return calculation just ignores. And I would challenge the idea that we can simply dismiss that as inefficient. The cost isn't just foregone returns, it's the cost of instability. Consider the research that shows households with low cash savings exhibit greater financial distress, so higher rates of missed payments or default, even if they theoretically have that high discretionary income you mentioned to cover shocks eventually. Cash provides immediate operational resilience. It prevents financial friction and stress that relying on future income redirection simply cannot guarantee in a crisis.
I appreciate that focus on operational resilience, but let's put the psychological benefit aside for just a moment. Can we agree that mathematically, the certainty equivalent calculation proves the longer your time horizon, the more expensive your psychological comfort becomes? You are paying a premium today for fear that may not materialize for 2 decades.
Yes, the cost is measurable, but the value is asymmetrical. And this leads us directly to the behavioral trade-offs, which, often drive these decisions. We have to acknowledge loss aversion.
I agree. Loss aversion is powerful. We know the emotional impact of a loss is felt roughly twice as intensely as the joy of an equivalent gain.
Exactly. So holding a substantial cash buffer is therefore a rational response to this emotional asymmetry. It prioritizes the avoidance of downward volatility and the extreme pain of loss over the pursuit of an equivalent gain. That cash buffer preserves the principal that provides peace of mind, and it allows the investor to sleep at night and adhere to their long-term plan without panic selling.
I see why you think that, but let me give you a different perspective. Using behavioral finance to support prompt investment. Staying fully invested once a plan is made is the default inaction. Behavioral studies on regret show a critical difference between actions and inactions. When investors choose to hold excess cash or try to time the market, they are making an active decision. They are taking action to deviate from their investment plan. Now, studies confirm that this type of action is associated with higher levels of regret when the outcome is negative. So, if you actively decide to sell stocks for cash and the market immediately jumps 5%, the regret you feel is much sharper. This is that upward counterfactual thinking than if you had simply stayed invested and the market had only gone up 3%.
So you're saying the best way to minimize regret is to just stick to the plan and prioritize the market's efficiency?
Precisely. The cost of waiting is high. Procrastination, or what some call Larry Linger syndrome, where you perpetually wait for the right moment, is the costliest mistake. The data supports creating a plan and investing as soon as possible to avoid the high behavioral cost associated with these active, regretted choices.
That's a compelling argument based on market volatility, but have you considered that for high earners, cash isn't just protection against market dips, it's protection against non-linear career risk? This is the specialized insurance component I mentioned earlier.
I think that's an area we do need to explore more deeply, as it's highly specific to this audience. What specialized risk are you referring to exactly?
I'm talking about career shocks. High-earning executives, partners in professional services, specialized consultants, they often face long, drawn-out job search timelines after a corporate restructuring or a non-compete clause kicks in. These are not 4-week unemployment periods. They can stretch 6 months, 12 months, or even more. During that time, they still maintain exceptionally high fixed costs. Multi-million-dollar mortgages, high property taxes, specialized health insurance, private school tuition. These costs are difficult, if not impossible, to reduce quickly. So the cash reserve is insurance against that career shock and the associated high fixed costs. During that time, they still maintain exceptionally high fixed costs. Having 6 to 12 months of these costs covered by liquid, non-volatile cash allows the high earner to negotiate their next move from a position of strength, taking the necessary time to find the right role, rather than being forced to liquidate growth assets at a loss because they need cash immediately to cover next month's tuition payment. That stability itself provides an invaluable non-market return.
I absolutely agree that risk management demands covering those fixed critical costs. However, we have to ensure that cash is only held to cover unavoidable short-term liabilities. The core principle remains that cash should only be beneficial for investors with low risk tolerance, extremely short time horizons, or goals that are already fully funded and just require preservation. If an investor, especially a high earner with a 20-year time horizon, deviates from a strategic, efficient allocation recommendation to over-allocate to cash, it means there is a fundamental conflict between their stated investment desires and their goals. That inefficiency, which we quantified with the certainty equivalent, it compounds severely over time. The decision to hold cash must be systematic and align with a well-defined framework, not driven by, emotional inertia or fear.
I agree completely that the choice must be systematic, but we have to account for the complexity of multi-goal investors where money is fungible. High earners often manage 3 or 4 major goals simultaneously: long-term retirement, college savings, a down payment on a second property, and a near-term major tax bill. Foregoing the risk premium on funds earmarked for a very short-term, critical goal, like next year's tax liability, may reduce the shortfall risk for that immediate goal to zero. This capital preservation property is critical for psychological stability concerning that goal, even if it technically makes the attainment of a separate, long-term retirement goal slightly harder. We are dealing with trade-offs. The systematic question then becomes, how much foregone return is the investor willing to pay for that capital preservation property on their various specific horizons?
And the critical distinction there is between necessary liquidity for defined near-term goals and inertia-driven excess cash. We've established the mathematical cost of holding inefficient cash, driven by both inflation and opportunity cost, resulting in hundreds of basis points lost over a decade. The evidence shows that prompt, consistent investment is the superior strategy for long-term growth and even helps mitigate regret.
And we have established the strategic value of cash. When it's viewed not as a poor-performing asset class, but as essential optionality, it buys time, flexibility, and anti-fragility. This is vital for protecting growth assets from the devastating effect of sequence of returns risk during distribution, and perhaps more urgently for our audience, it provides the essential psychological resilience needed to weather both market volatility and those high-cost, nonlinear career shocks.
Ultimately, the optimal allocation depends entirely on the investor's specific circumstances, their actual risk tolerance, their time horizon for each distinct goal, and the funding level required. The frameworks are quite clear on efficiency.
But the decision requires balancing that measurable, quantifiable cost of foregone returns against the often immeasurable value of resilience, the avoidance of loss, and, well, peace of mind during times of high stress.
Which leaves us with the critical closing question. How much optionality are you personally willing to pay for in foregone returns? Thank you for joining the debate.